So Stream's building the universal margin layer. This is going to go over how a universal margin layer, or UML, allows you to mitigate the negative results of fragmentation and liquidity, particularly when it comes to derivatives. So I'm going to go over the history of markets, the original markets, and how they were formed. Financial markets were born out of markets, physical goods, market centers, and we'll kind of find them. A review of DeFi and CeFi market structure, as well as TradFi market structure, the pain points there, and the solution to some of those pain points that Stream movement. So the original markets are all for physical goods. So, Caveman Bob owes Alice a big chunk of meat, and Alice might pay back a bunch of grain, just like that. The Silk Road came along, and there were major centers around strategic geographic areas: Italy, Greece, and Turkey, Egypt, India. A lot of these started to create states that were oligarchical and instead of hereditary in terms of how power and wealth was concentrated. And that's because of the nature of these markets. Merchants that were very good at their craft wanted to be somewhere where the king could just take away all of their money. And so the movement of goods across long distances required credit. It's very inefficient for you to take a ship carrying just a bunch of money one way, when instead you can have a situation where one person wants money in one location, one person wants money in another location, and we kind of swap it. Which ironically is how a lot of cross-border payments happen in countries with tight currency controls. You're in Argentina and you want $1,000 outside of the country, and another person wants $1,000 inside of the country. You don't do it directly. You have both of these people basically swap the obligations outside of it, avoid this kind of now a financial issue, but back then it was like a physical issue. You didn't want to actually have to move that distance. So that is where credit was basically created, because you had to have a system where someone owed you money and another person would be owed that money. And the availability of credit was what allowed for a lot of these financial centers or commercial centers to become very powerful. If you think about Milan, if you think about Florence, the Medici family, the origin of banks, that's how all of them originally started, was basically to enable this more easy movement of money. And then financial markets are born out of that, basically to create tranches. So the division of risk and rights to different rewards, financial rights. So the first banks were created in Italy. The word bank comes from the Italian banca, which just means bench, where people would do exchanges of different currencies with different denominations, different metals. And the first real stock exchange was in Amsterdam, which created the Dutch East India Company, which is the Dutch acronym is VOC, which was the most valuable company in history. It was valued at $4 trillion, which, for some context, is double roughly the value of Saudi Aramco, the largest producer of oil in the world. And then the Dutch corporate model was a lot better for lending because of the fact that it was more aggregate, in the sense that people that were lending to the Dutch East India or West Indies Company were lending to an entire corporation. They weren't just betting their money on one single voyage, which had a very high potential failure rate. They were betting on an entire venture with multiple different voyages. So as a result of that, the Dutch could borrow at a 4% interest rate on gold, which at the time, interest rates being different wasn't really a big deal because no one dealt in currency, it was gold or silver. So they could borrow 4%. Britain, which was doing joint stock ventures, which would only be focused on one or two voyages, you would actually have to lend at 10% because of the risk associated. So as a result of that, the Dutch, even though they didn't have, their own trees to build their own ships, they didn't have a bunch of the resources that they would really need. Most of this country was swamp. was entirely swamped and unusable. They were able to get the capital that they needed to build out this company and then to become a really powerful force that even up until the 20s, the Dutch were controlling Indonesia for all the spices. At that point, Europe switched from a corporate system to the government control for that kind of trade. And then this kind of shows an example of how financial markets all concentrate, where assumptions that can be made and where they get perspective. So basically, rule of law, you're lending to someone, you expect them to pay back, and if they don't pay back, you have a way to get the money back. Whereas, if you were lending the British weren't sure if the voyage could get messed up. There was a reputation over risk. You were lending to the government, which would devalue your currency. So as a result of that, the Dutch did very, very well. If you look at today, you have a bunch of different market centers around the world. You have New York, which is the center of equities around the world. You have Singapore, which is the center of family office wealth and foreign wealth, especially for Asia. You have London, which is the main forex and currencies market, or not currencies market, derivatives for metals market in the world. You have Hong Kong, which is like the entrance point for capital, an exit point of capital to China, to and from China. Chicago is the commodities hub of the world. Mumbai was the financial center of the Dutch or the British East Indies Company. In India, remains the major financial center of the country. Dubai is where the Switzerland, to an extent, of the Middle East. Sao Paulo is the largest financial center. So there's still a geographical aspect of this, but they also are all specialized in some way, and they're the best in some way. Dubai also, for example, is a very well-known area for oil trading. It's where a lot of the Russian oil that's not supposed to be sold above a certain price level gets moved through. So in spite of the global nature of the world economy, we don't actually have global markets. Or to be more precise, we don't have global exchanges. All exchanges are limited by their jurisdiction. So you have NYSE, NASDAQ in the US, alongside CME and LCC, which are clearing houses, which we'll get into more. You have different exchanges in the UK, France. Some of them are owned by American companies or larger conglomerates, but they're all different. They have different liquidity. They're not interoperable. And so whenever you're swapping your money around, the only markets that are really global are markets for money to transfer, basically almost a bridge in a DeFi sense or in a crypto sense between these different markets. And outside of that, if you want to buy something in Hong Kong, even if you're buying through an American company, you're using a different exchange or you're using a broker that is going to that exchange. And that's because the medium in which these assets exist, whether they're physical assets like commodities or companies, is very different. An American exchange can't really go after a Chinese exchange, which is why a lot of the stocks that were Chinese stocks in the US did very badly, because all of a sudden a lot of American investors got defrauded. And then these investors wanted to go after these fraudulent actors, but it was an American exchange, and they didn't really have the ability to go after people in China. So that's an example of how that doesn't really work, even if you want to try. There's examples of British companies and other companies that aren't in areas that kind of work with the US government very closely. They might list in the US, but it's still not a really global market. So now the DeFi and CeFi, the exchange volume is becoming more fragmented over time, not less. Even after FTX, we saw Binance kind of grow a bunch, but increasingly we see that countries are trying to force out these kind of large international exchanges and trying to have their own local exchanges to reflect the fact that, there's a jurisdiction issue. If you're India, you don't want a bunch of Indian wealth being held by a Chinese company or an American company. You want it to be held by an Indian company, and you want the profits to be held by an Indian company. So in a way, this is akin to how electronic trading started in around the 1970s. All of a sudden, there was Archipelago, which is now NYC Arga. There are NYC at Nasdaq, right? 100% which one bought it, but and then there was that. So all these different exchanges that were basically almost layers on top of the existing framework, which was like, hey, I don't want to wait 2 days or a minute to be able to place an order and close an order. I want to be able to do that in seconds and in milliseconds and in nanoseconds. And that's where all these exchanges happen. And in theory, the way that we look at fragmentation is like, holy shit, this is horrible. This is really bad for me. But what's really interesting is that actually liquidity improved dramatically. And there's a couple of reasons for that. The main reason is that because market makers could adjust their spreads pretty quickly. And the other reason is that, especially for when it comes to the actual obligation layer, in the sense that there's a layer below the matching where you agree to a price with someone else. You guys both have the obligation. One person owns the one person owns the asset. That layer actually remained constant. So if you're doing a transaction with someone, whether it's on Robinhood, on JP Morgan, or on any other platform for options in the US, you're using the options trading corporation, which is making sure that the person who sold you the option maintains that right to you, and the person that is buying the option is basically being able to receive that option. And so in the event that there's some kind of liquidation or something like that, the clearinghouse steps in against that person and make sure that you can actually get your assets delivered to you. That's the same also with equities in traditional finance. DTC, which is the Depository Trust and Clearing Corporation, which is actually a government agency. All stocks in the United States are actually owned by the DTCC. You can't actually legally own a public stock on your own. You have to have it with the DTCC. Another thing I want to go over is that DeFi actually wins movements, parentheses saying sometimes. So DeFi is the primary place in the state to launch new assets. If you think about last cycle with Safe, the Shiba Inu, a bunch of these other assets, they've all launched on like EXL, which was like an early pumped up fund. Then if you think about today with, if you think about all of these kind of more community driven projects, the best place to launch those projects if you don't have an in with an exchange is in DeFi. Borrowing when it comes to retail, DeFi has some of the largest volumes and most efficient markets for that. And when it comes to staking, Coinbase has its own staking product. Binance has its own staking product. You add the TNL of those two products together, you get less than the total staking value of RETH, which itself is 1/10 of Lido. So there's a bunch of reasons for that. One, it's Lido doesn't have the custody risk that Coinbase or the Binance has. It's also interoperable. It has better liquidity on chain, and you can use it as collateral for when it's interoperable. So you can use it as collateral for most of these assets, and now obviously you can use it for ID layer, which is number 2 there. And the main thing is the lack of smart contract risk. Or not the lack of smart contract risk. You replace counterparty risk with smart contract risk, and you replace probabilistic odds in theory with deterministic odds, which is that there's a bunch of tail events that can happen with STD where it can GPEG, but you can kind of mathematically prove the likelihood of that, whereas proving that the SEC is not going to make Coinbase go big, or Binance isn't a bunch of money. You can't prove that even if it's a very low likelihood. All markets and all people that like to maintain their wealth like to be able to quantify risks. This is an overview of how wallet flow works right now. So say you're a user and you're using Lemon Ducks, which is an Argentine wallet. You want to buy $1,000 worth of Bitcoin. You send a request for quote to the exchange. This exchange doesn't have its own central limit order book, so then it sends an RFQ to other exchanges and to market makers, and it adjusts to try and get that best pricing, and then it sends the order to the user. And then when it comes to the actual market level, you have all of these different exchanges, especially when it comes to derivatives. You have DYDX, you have Devo, you have Drift, you have Hyperliquid. They all are not interoperable. And whenever there's a pricing difference, you can only take advantage of that difference by selling essentially a position on one exchange and buying on another exchange. So it's all liquidity dependent if you want to actually have people market making. And that's a really difficult problem to solve for, because then even if there's a massive opportunity to take advantage of mispricing on, say, EYDX, if it then flips to liquidities that you have, you actually can't make money. So that means that in theory, you, as a market maker, could be trying to make money off of the volume on all these different venues, and net long on one platform and net short on another platform. Those positions aren't balancing each other out. You have to continually balance, which makes no sense, because in the traditional market, you have this system. This is obviously how market makers make their money. They have this system where they're making a spread by selling at a low price or a higher price than what they buy at, and they make money on it. So the fact that the volume is forced to be fragmented, and they can't prove like, hey, look, even though I've been mostly buying on UIDX, I've actually mostly been selling on data. And so these positions should balance out and actually healthy. But there's no way right now for any of these protocols to actually see that. So as a result of that, that's why market makers charge massive interest rates, massive rebates to exchanges. That's why Robinhood gets paid millions of dollars a year for that order flow, and DEXs actually are continually paying tens of millions of dollars a year for their order flow. So again, as a result, Robinhood users actually get better execution than if you run a trade as a normal, you're a normal broker, like through JP Morgan or anything like that. And the reason why is because they're selling to market makers. It's complex. There's some good white papers that go over this, but it's basically a reputation-based system of, can this market maker historically give me better pricing on this pair compared to what I can get somewhere else or compared to other market makers? And that the reason why the market makers can provide that is not necessarily that they're going, that they're trading against the user, which is something that but it's because of this idea, in the sense that, especially with Robinhood, the order flow is very different type of order flow from what they might normally be getting from institutions and other stuff like this. So a lot of the time with Robinhood, the institutional users might be selling a bunch, like in the case of GameStop, but their retail users actually want to buy a bunch, and they make money by having large volumes on both sides. So it actually makes a bunch of sense for them to buy and get better execution on this, because then that means they can counterbalance these order types when they don't have inventory risk, because they're basically able to make sure that they're selling and buying as much as possible, getting more of a spread, and they're not stuck either holding, in this case, GME, or holding just cash as GME goes down. So crypto has better settlement at the spot layer, because basically settlement, the clearinghouse in quotes, is the universal ledger of the blockchain itself. You have less systematic risks in the sense that there are some systematic risks, obviously. Tarun would hate me for saying there's not systematic risks in DeFi, but they're deterministic, and you can kind of roughly within certain parameters see what those risks are. You have more market participants, which is actually a way better situation to have than all of these other markets where information is gated behind a very expensive subscription service. So, for example, if you think about, a farmer's market in a very expensive suburb versus a market in Mali, the price of the same asset, say is a loaf of bread, can be very, very high, because and the traders in the suburb, because there's a bunch of people with a lot more disposable income willing to buy that bread. Whereas in Mali, it's a very different situation. I don't know in general, obviously, but that's like a very small example of how markets aren't necessarily efficient natively. They're efficient based on their participants. That's the same reason the Athena trade exists. Because why are you able to do, to an extent, a risk-free basis trade? It's because everyone wants to be long and buy leverage. No one wants to sell that leverage if they have exposure to crypto. Why are you going to be in crypto for 4 years and then make, maybe at the high end, secure 20% annualized when you're missing out on the potential of 100, 200% annualized if you just hold spot? So that's why these kinds of things exist, because of the market participants. So what is needed to actually solve for this is, like, basically almost every way DeFi is better. It isn't better when it comes to the clearing process. So there's a different margin requirement when you're using AVO. There's a different margin requirement when you're using YDX. The funding rates are determined by how much margin is in all of these contracts. There's different margin requirements for options. Most options you have to fully collateralize, which is something that is never done. If you've ever used even Robinhood and you don't even have like a good relationship with the broker, it's never done that way. You need this kind of universal margin layer that these exchanges can plug into, so that they can be like, okay, actually I can see that you're not long here, and those positions balances. Then that actually becomes a lot more efficient, and it becomes a lot more efficient for the market makers, because now they actually have a system where they can see those positions. The main thing there is, how do you make sure that they can plug into that and feel like they're safe, which is the main issue. They're essentially giving away a core part of their stack. You have to give them some kind of sense and some kind of security. Then giving away the margining layer is not going to be a systemic risk to them, and it's not going to be a systemic risk to competitive advantage, so to speak. So this is basically our fix. So we're building the universal margin layer for these exchanges. So exchanges will match the orders themselves. They can have their own liquidity if they have a really good market maker agreement, or they have their own liquidity providing service like Hyperliquid does. They can still keep that liquidity on their own exchange, the same way that if you send an order on Robinhood and there's an order that matches on Robinhood, the order will actually match and won't go to the market maker. But if there is no one who's willing to take that order on your exchange, then we have like a lower level common order book that has all of these positions and then manages the margin. So that is also cool, because then Hyperliquid's gotten some flack for its WIPs, which basically happened because the HLP does a very smart financial decision, and it sees a very large order, and it's like, I statistically can't properly hedge out this position. It doesn't make sense for me to, so I'm not going to market make that entire order. And that causes a WIP, which causes some people to get. In this system, that WIP would actually get basically the common order book, and that wouldn't impact users the way it has in the past. It would also allow for the Hyperliquid, the HLP itself, if it wants to hedge out its exposure via spot. So we have integrated. When you provide BTC as spot to go short BTC, you can provide STE to go short ETH. You can provide, as a user, a USD equivalent, which can be like a stage, which earns yield, and all the settlement happens in one USD equivalent, or USDY as well. So we also have our own service which matches liquidity to users. So you can think of market makers basically take most of their funds, whether it's from debt or generally is in debt form. They take it in as debt, they earn a higher yield, and then they return the money as debt, they keep a spread. So, Coinbase even offers this. They offer 4% on BTC. Galaxy, they offer 6%. You lock up for 2 years. They pay you interest rate after the term is done, or whatever it says. Maybe the interest is separate from the principal. And then they keep the spread, which tends to be relatively. But the waste product, so to speak, of that is that you're providing liquidity into these platforms. You're providing liquidity on CME. You're providing liquidity doing a perks trade. So what we find interesting is, since I used to work at market makers and a prop firm, we provide this service to people for free. It's more liquid. We're going to also allow for more duration based, like longer epoch, so that you can do kind of better trades to an extent. But right now, it's a 1 week epoch. You basically provide liquidity in the most efficient way possible. And for the user, you get some of the highest yield you can get on BTC, on ETH, on USD. We're averaging 10% plus even right now during bad markets. On USD, we're doing 3 to 6% on BTC right now. We did on 1 week 28% annualized. And on ETH, we've been averaging 10% plus. And so you're able to create a market where you actually are matching the people that want to essentially provide liquidity, but don't necessarily realize they want to provide liquidity, and the people that are trying to take that liquidity in this form of exchanges. So you're putting that in one house, the same way that Pendle creates a system where people that want to speculate on yield and sell their exposure to the principal. The people that want real yield can buy it to real yield. So the value that I have here is that exchanges get better execution, leverage, and liquidity. Market makers get standardized margin and insurance cooked in. The insurance cooked in side is we use EigenLayer for security. A cool aspect of this is that the solvency is actually a responsibility of the validators. So if there's a major issue or this market manipulation kind of event, it'll get flagged. And if the validators don't properly slash and manage that position, then they themselves will get slashed, and that difference will be used to basically keep the whole situation solved. Obviously, that's limited. And in the worst case scenario, as any derivatives exchange should have a deleveraging event. But that basically allows, as a market maker, you can kind of use this platform and think of like the fees that you're paying that's going towards paying for insurance, which normally is an additional cost. And for users, you get lower funding rates, you get higher leverage, like in the case of BYDS right now, because you can't prove that you're actually hedged. It's only USDC margin. You get soft liquidity starting at 33x leverage, which is not particularly known by users, because you can do 20x leverage, and when the price moves 2%, you start getting soft liquidated. And then you get deeper liquidity. So you're essentially, if you send out an order and one exchange can't process it, ideally you start to have a system where you can send these orders and they can get aggregated across all of these different platforms. And that's fine because the actual position is the same, in the sense that you can then take your per BTC vault, for example, and sell it on this exchange, or sell it on this exchange, or sell it on this exchange, because it has all these are standardized. They're all a standardized unit. They all follow standardized market, etc. So that's a cool aspect of that as well. This is kind of going back to like matching users. 0 to 1 liquidity begets liquidity. You need liquidity for users to want to use you, but you need users to normally get liquidity. That's why we have our current vault, which allows you to earn yield. That's our way of getting liquidity first, and then we can go to exchanges, we can go to users and basically say, hey, we can provide liquidity now for you. And you basically can match those two markets. You have to, most protocols in DeFi are good protocols because they're able to create a product that basically a buyer and a seller want to use. So like, for example, a project that wants to launch on V2, they like the fact that you can have a constant market maker, because that means always someone's going to be able to buy and sell the asset. And the user likes the fact that you can always buy and sell the asset. You can argue about price discovery and whether that's super efficient. It's not in terms of math, but it's why it worked. With lending, an IRM, an interest rate model, all it does is it's coordinating capital so that people that deposit will be incentivized to deposit, and people that borrow will be incentivized to borrow based on utilization and all this sort of things. So this enables us to provide liquidity to exchanges and to incentivize integrations on top of mathematically being able to say, like, this is far more efficient, 3 to 10 times efficient than what we're currently doing. Additionally, exchanges are not focusing on the clearing level. If you talk with Hyperliquid, if you talk with UIDX, if you talk with almost any of these exchanges, they're focusing on speed. They're focusing on having permissionless listings. They're focusing on basically user features, user-facing companies. So if you can solve for the clearinghouse level, you can basically solve for a problem that they're not necessarily focusing on. You can allow for the specialization of exchanges. The same way that in traditional finance, you have lit pools, you have dark pools, you have pools that only have certain participants in order to avoid bad faith order types or bad faith order executions. And that's like a natural part of how liquidity is provided, because inherently the availability, already talked about it a lot, can be incredibly negative for liquidity providers. Yeah. The DMM product's live. We're currently at 20 mil TVL. We're going to add 9 to 12 in the next month. We plan to launch our testnet in Q3 2024. We're auditing and then we launch it V1 and then Q4 and Q1 of 25. And you can have spot cloud, you have integrated spot lending, and you have spot margins as well. This is the team. That's it.
Questions first, how to join is the anything?
We're using Ethos for the set. Basically, the amount of validation set at the item like
If it's possible to share some contracts or and second question, for example, we have the complete of investors. This is we collect some funds and we collect these funds for the time period of the 1 week, for example. And we don't want that our see are just waiting, and people don't want to wait because they want to do it. So it can be, for example, the process of collecting these funds to the market rate to get some extra deals with green our amounts. This is the negotiation.
You can deposit. It's a 1 week ELOC. So you deposit.
Yeah, people live usually 1 week, like, we want to invest sometimes in around 1 week. People collect for 1 week, and we are just going to that these funds are starting to
Deposit via the front end. Any other question?